Argentina entered the late 1980s in a state of monetary disintegration. Annual consumer price inflation reached approximately 3,079% in 1989, according to IMF historical data, meaning a good that cost 1 Austral in January would cost roughly 31 by December. An earlier stabilization attempt, the Austral Plan of 1985, briefly suppressed inflation but collapsed when the government could not close its fiscal deficit. Without reliable foreign borrowing and unable to raise taxes or cut spending sufficiently, the government of President Raul Alfonso printed money to cover the gap, and each new note issued eroded the value of every note already in circulation. By mid-1989, supermarkets were posting new prices twice a day, and workers demanded weekly pay so their wages would not lose value before they could be spent. Hyperinflation of this scale is not simply an inconvenience, it destroys savings accumulated over years, eliminates the ability to plan, and leaves the government functionally unable to borrow at any reasonable cost. Incoming Economy Minister Domingo Cavallo, under President Carlos Menem, proposed a radical structural fix. The convertibility law, enacted on April 1, 1991, established 3 binding rules. The central bank was required to hold at least $1 in foreign reserves for every peso in circulation. The exchange rate was fixed permanently at exactly 1 peso per dollar, and that rate could be changed only by an act of Congress, not by executive or central bank discretion. This structure is called a currency board arrangement, a mechanism with precedent in British colonial territories such as Hong Kong, but new for Argentina in this form. By making devaluation legally and politically nearly impossible, Cavallo was betting that Argentines would trust the new peso the way they trusted the dollar, because by law each peso was fully convertible into a dollar on demand. The plan delivered, at first, on an almost dramatic scale. Inflation fell from thousands of percent to roughly 7% by 1993 and to near zero by the mid-1990s, according to World Bank consumer price data for Argentina. GDP grew at an average of roughly 6% per year in the early 1990s by World Bank national accounts data. Foreign capital flowed in because investors trusted a peso they could always redeem for dollars. Argentina returned to international bond markets, largely closed to it during the hyperinflation years, and the government borrowed at interest rates far lower than at any point in decades. The convertibility plan attracted significant attention from international economic institutions as a case study in how an exchange rate anchor could stabilize a developing economy. For ordinary Argentines, the stability was a genuine relief. Savings held real value. Businesses could sign contracts in a currency worth something a year later, and foreign goods became affordable for the first time in a generation. A currency board, by design, strips a government of its main tools for responding to a recession. The central bank cannot cut interest rates to stimulate borrowing, because doing so risks sending capital abroad in search of higher returns elsewhere, draining the dollar reserves that back the peso. It cannot print money to cover fiscal deficits, because every peso must be matched by a dollar in the vault. When the economy slows, the only available adjustment under these constraints is what economists call internal devaluation, cutting wages and prices directly through the domestic economy, which is far slower and more painful in practice than a currency devaluation. A further mechanism operates at the border. If trading partners devalue their own currencies, Argentine exports become relatively more expensive, even though nothing has changed inside Argentina. The convertibility plan had solved hyperinflation by locking in discipline, but the same lock that kept inflation out also kept adjustment mechanisms out. On January 13, 1999, Brazil abandoned its own exchange rate band and allowed the real to float freely. Federal Reserve exchange rate data and contemporary reporting show the real depreciated by roughly 40% from its pre-float level within the weeks that followed. Because Brazil was Argentina's largest single trading partner and a direct competitor in export markets, this shift hit Argentine exporters hard. Argentine goods, still priced in dollars by the convertibility mechanism, were suddenly far more expensive than comparable Brazilian goods in every third market where they competed. Argentine manufacturers began losing orders. Export revenues fell. The damage worked entirely through the price mechanism, requiring no direct financial contagion between the two countries' banking systems, and it arrived at a moment when Argentina was already carrying a debt load that had grown through the 1990s. Argentina entered recession in 1999 and had no monetary tools to respond. Tax revenue fell as employment and output declined, widening the federal deficit. The government could not print money to close the gap, so it borrowed in international bond markets. IMF article The FERC consultation reports for Argentina document a rising debt burden through the late 1990s and into 2001. The government attempted successive rounds of spending cuts to reassure creditors, but each round reduced public demand in an already weak economy, further shrinking the tax base and requiring the next round of cuts. By October 2001, Argentina's National Statistics Agency INDEC reported the official unemployment rate at approximately 18.3%. Some economists argued at the time that measures including underemployment placed the true labor market distress considerably higher. Interest payments on the growing debt consumed an increasing share of federal revenue, narrowing the options available to policymakers with each passing quarter. In December 2000, the International Monetary Fund, the World Bank, the Inter-American Development Bank, and the Spanish government assembled a multi-creditor support package worth approximately $39.7 billion, known in Spanish-language press as the Blind Aging Shield. The package was intended to break a self-reinforcing cycle in which rising perceived default risk increased borrowing costs and rising borrowing costs increased default risk further. The conditionality attached required Argentina to reduce its fiscal deficit to zero by 2001, a target that proved unreachable as the recession deepened. Bond spreads on Argentine sovereign debt continued to widen through 2001, signaling that markets were pricing in a rising probability of default. In August 2001, the IMF disbursed an additional $8 billion tranche. Economy Minister Cavallo, recalled by a new government specifically because he had rescued the peso once before, introduced a voluntary debt swap in November 2001 that extended maturities and reduced near-term cash requirements, but it was widely read by markets as a sign of deepening distress rather than a genuine resolution. On the night of December 1st, 2001, Economy Minister Cavallo announced a set of emergency banking restrictions that became known as the Corralito, from the Spanish diminutive meaning small enclosure. Beginning December 3rd, all account holders were limited to withdrawing no more than 250 pesos or dollars per week in cash, and transfers of funds abroad were prohibited. The measure was intended to stop a bank run. Argentine depositors, fearing that a coming devaluation would reduce the dollar value of their accounts, had been quietly moving funds offshore for months, with outflows accelerating sharply in November. The Corralito froze tens of billions of dollars in deposits across the Argentine banking system. The political and social response was immediate and severe. Argentines who had built dollar savings over years, or who needed cash to pay suppliers or run small businesses, found themselves legally locked out of their own accounts. The freeze became the direct trigger for the political collapse that followed. The protests that followed the Corralito escalated rapidly. On December 19th and 20, 2001, street demonstrations in Buenos Aires and other cities turned violent. Human rights documentation compiled in subsequent Argentine judicial proceedings attributed at least 27 deaths to clashes between protesters and security forces during those 2 days. President Fernando de la Rúa declared a state of siege on the evening of December 19th, a move that intensified rather than suppressed the demonstrations. He resigned on December 20th, 2001, departing the Casa Rosada by helicopter as crowds gathered below. Senate President Ramon Porta assumed the executive briefly. Congress appointed Adolfo Rodriguez Sá as interim president. Standing before Congress on December 23rd, Rodriguez Sá declared that Argentina would suspend payments on its external debt, drawing applause from the assembled legislators. He resigned within days. Eduardo Camano served briefly as transitional caretaker. Eduardo Duhalde was finally appointed by Congress on January 1st, 2002, the fifth person to hold the executive office in less than 2 weeks. It was Duhalde who governed through the rest of the acute crisis. The default declared in December 2001 was, at the time, the largest sovereign debt default in recorded history. Estimates of the total face value of bonds affected vary across academic and official sources, ranging from approximately $81 billion to over $100 billion, depending on which instruments are included. A commonly cited round figure in the financial and academic literature is approximately $100 billion. On January 6, 2002, President Duhalde formally ended the convertibility law. An initial official exchange rate of 1.4 pesos per dollar was set for most transactions, but the peso was allowed to float freely in February 2002. By approximately June 2002, the peso had reached roughly 3.5 per dollar. The government also converted bank accounts. Dollar deposits were pesofied at 1 peso per dollar, while many dollar-denominated bank debts were converted at 1.4 pesos per dollar, an asymmetric arrangement that transferred wealth from depositors to debtors and generated years of litigation in Argentine courts. By World Bank national accounts data, Argentina's GDP contracted by approximately 10.9% in 2002. Beginning in 2003 under President Nestor Kirchner, Argentina's economy recovered faster than many external observers had forecast. A devalued peso restored export price competitiveness. A global commodity price boom lifted demand for Argentine agricultural exports, and strong fiscal positions supported public spending. By World Bank GDP data, Argentina grew at roughly 8 to 9% per year from 2003 through 2007. In 2005, Argentina completed a debt restructuring in which approximately 76% of creditors by face value accepted new bonds at a substantial discount, with most estimates of the effective recovery rate in the range of 30 to 35 cents on the original dollar of face value. A second exchange in 2010 brought total creditor participation to approximately 93%. A group of holdout creditors who had refused both exchanges, led by the fund NML Capital, pursued Argentina in U.S. federal courts under the New York law governing their bonds. In 2012, U.S. District Judge Thomas Grisa ruled that Argentina could not pay restructured creditors without simultaneously paying the holdouts in full, a decision upheld on appeal. The resulting standoff pushed Argentina into a technical default on its otherwise performing restructured debt in 2014. Under President Mauricio Macri, Argentina reached a settlement with the principal holdout creditors in 2016, paying approximately $4.65 billion to resolve those claims, ending a legal dispute that had run for 15 years. Argentina's causal chain from 1991 to 2002 illustrates several mechanisms that appear in contemporary financial markets. A fixed exchange rate can deliver genuine stability for years and still carry a structural vulnerability that only becomes visible when external conditions shift. The Argentine case shows how a peg that worked for a decade came apart within months once a trading partner devalued and recession deepened. Currency risk in emerging market bonds is not a hypothetical. Argentina's case is a documented episode in which nominally dollar-denominated deposits lost a substantial fraction of their dollar value when the peg ended. The sovereign debt restructuring process has no formal equivalent of a bankruptcy court. Creditors holding bonds under certain governing laws can pursue a sovereign debtor's assets internationally for many years after default, as demonstrated across 15 years of litigation here. The Argentine case contributed directly to the widespread adoption of collective action clauses in new sovereign bond issuances after 2003, legal provisions designed to make it harder for a small group of holdout creditors to block a restructuring agreed to by a large majority. And the Corralito is a documented example of how a government under reserve pressure can restrict access to bank deposits without those deposits formally defaulting. None of this implies any specific outcome is inevitable in any future situation. Every sovereign debt episode differs in its particulars. Argentina's story is studied precisely because it contains all of these mechanisms in one clearly documented causal sequence.